Welcome back to Investing Talk podcast. Today, we're looking into a company that's, well, really turned things around in a big way, Core Scientific. And the big question, the one lots of you are probably asking is now a good time to buy? Our goal today is pretty straightforward. We want to cut through the noise, look at all the information we've gathered, and pull out the key insights for you. So by the end of this, you should feel much more informed about Core Scientific's potential, but also, importantly, its challenges. Before we get into all that, if you find these discussions helpful, please do take a second to subscribe, like this analysis, maybe leave a comment with your own thoughts. And if you feel like supporting what we do, perhaps consider buying us a coffee. It genuinely helps us bring you more of these analyses. Okay, so let's get into the story. It's quite something. Core Scientific, they went from being a, let's say, distressed Bitcoin miner facing serious trouble to, becoming a significant player in high-performance computing, especially for AI. That's quite the leap. What's the main story arc here? How dramatic was this change?
It's fascinating. The shift itself is pretty radical. You have a company that was all in on digital asset self-mining, and as you know, that's a volatile business, hugely capital intensive, very tied to crypto prices. Now they strategically pivoted, really repositioned themselves completely. It's not just a tweak, it's a whole new direction.
Okay, a whole new direction. So what does that pivot really mean for their outlook? I mean, is it less risky now or just different risks? What's the overall assessment?
Well, our analysis gives Core Scientific a 6 out of 10 rating. We see it as a speculative investment. That means, there's some moderate potential in the shorter term, but it definitely comes with significant risks you can't just brush aside. It probably fits better for, say, long-term investors, people willing to accept higher risk, maybe looking 2-3 years down the line for this to fully play out.
Right, speculative long-term horizon. Now, this is where it gets really interesting, I think, the financials. In Q1 2025, their total revenue was down sharply, like 55.7% year over year, down to $79.5 million from almost $180 million. But then their net income just soared. $580.7 million compared to $210.7 million the year before. How does that even happen? Plummeting revenue, soaring income.
Yeah, that disconnect raises a really important point, and it's crucial to understand if you're looking at this company. Where did that huge net income number come from? It wasn't really from their core operations getting suddenly profitable. It was largely driven by non-cash mark-to-market adjustments on warrants.
Ah, okay, paper gains.
Exactly. Paper gains, these things fluctuate in value, and that hits the net income line. But it doesn't mean cash is flowing in from selling services or mining Bitcoin more profitably. The revenue decline, that tells the operational story. It reflects the Bitcoin halving, cutting into mining rewards, and the fact they're in the middle of this big pivot to AI infrastructure.
So it's messy right now, operationally. Can you break down that revenue picture a bit more? Where did the money actually come from in Q1?
I can. So digital asset self-mining, their old core business, that revenue fell significantly, down to $67.2 million from nearly $148 million year over year. Huge drop.
Wow.
Colocation services, where they host gear for others, brought in about $8.6 million. And hosted mining added another $3.8 million. But maybe the starkest figure is the gross profit margin from their own Bitcoin mining. It just collapsed from 46% in Q1 2024 down to only 9% in Q1 2025.
9%.
9%. That really shows you the post-halving reality. They estimate it now costs them around $56,627 to mine one Bitcoin. Suddenly, your costs are almost matching your potential revenue.
That definitely paints a picture of a challenging transition. Really underscores why they needed to pivot so hard.
It does. And you see it in the operating results, too. They reported an operating loss of $42.6 million in Q1 2025. Compare that to an operating income of $55.2 million in Q1 2024. It highlights just how tough this transition phase is. But, and it's important, they do have strong liquidity. They're holding about $778.6 million in cash, equivalents, and digital assets. That gives them a cushion, some breathing room to execute this shift.
Okay, that cushion is key. Which brings us to the cornerstone, really, of this whole transformation story, the partnership with CoreWeave. This sounds like a massive deal. What does it actually mean for Core Scientific's future revenue and, their place in the market going forward?
Oh, this partnership is hugely significant. It's potentially transformative. The headline number is it could generate over $10 billion in revenue over 12 years.
$10 billion over 12 years.
That's the potential. It provides a long-term contracted revenue stream that's very different from the volatility of mining. They're already on track to deliver 250 megawatts of power capacity, specifically for CoreWeave, by the end of 2025. And they anticipate that hitting an annualized colocation revenue run rate of about $360 million as they enter 2026. That's substantial.
And they're actually building out new capacity, dedicating resources just for this CoreWeave deal, right?
That's right. They are committing significant resources. The total contracted power capacity goes up to about 590 megawatts across 6 different sites. This really positions them as a leader, or at least a major player, in providing the infrastructure for high-density GPU hosting, the specialized data centers needed for heavy AI workloads.
So they're tapping into that massive demand for AI compute power.
Precisely. And if you look at the bigger picture, the whole AI infrastructure market is expected to just explode from maybe $79 billion in 2023 to nearly $400 billion by 2028.
Wow.
That's a compound annual growth rate of around 38%.
Yeah.
So they're positioning themselves in a market that's growing incredibly fast.
So it seems like a smart reuse of their existing assets, leveraging what they already built for crypto mining, but for this booming AI sector.
That's exactly it. They're using these state-of-the-art facilities, which were already designed for high power density, which is perfect for hungry AI servers. This gives them a competitive advantage because power and suitable data center space are actually becoming scarce resources in this AI gold rush. And critically, this shift into AI hosting offers a much more stable, contracted revenue model, potentially with better margins than the crypto mining business they're moving away from.
Okay, so the strategy makes sense. Let's talk valuation. Given this huge shift, how is the market pricing Core Scientific? Market cap is around $4.87 billion.
Yeah, looking at valuation is tricky here. From a traditional viewpoint, trading at 16.4 times trailing revenue, well, that might look expensive. And the PE ratio is negative, minus 4.17, because of those past losses we talked about.
Right, the backward-looking metrics aren't great.
They aren't. But, standard valuation methods might not fully capture the value here. They don't easily account for the future potential of these massive AI contracts or their strategic position. The enterprise value is over $2.57 billion, and the price-to-sales ratio is 4.34. Given that contracted revenue backlog and the growth trajectory in AI, that 4.34 price-to-sales seems perhaps more reasonable.
So the market might be looking forward more than backward. What about the analysts? Are they buying into this transformation story?
The sentiment from analysts is, well, overwhelmingly positive right now. The average price target is around $18.34, which suggests about 12% upside from where it is currently trading. And the consensus among 17 analysts covering the stock is strong buy. Targets range from $14.50 on the low end up to $24. We've seen recent positive actions too. Roth MKM kept their buy rating with a $20 target. Needham actually raised their target from $16 to $18. Importantly, there haven't been any significant downgrades recently, suggesting Wall Street generally believes in this AI infrastructure pivot.
Okay, strong analyst support. What about the big money? Institutional investors, the funds, the pensions, are they getting on board?
These certainly seem to be. Institutional ownership is quite high, around 77.7% of the outstanding shares. That indicates pretty strong confidence from major institutions. And if you look over the last year, institutional buying was about $1.46 billion, while selling was only around $295 million.
So net accumulation.
Definite net accumulation. That's generally a bullish sign. You've got notable holders like Clearline Capital, Fred Alger Management, Parsifal Capital Management, and several institutions have been significantly adding to their positions.
That's compelling. Now, on the insider front, sometimes we see executives selling even when the story looks good. What's the picture there? It looks a bit mixed.
That's correct. It is a bit mixed. Recent filings show some selling by top executives, including the CEO and CFO. However, it's not all one way. Some directors have actually been buying shares. Yidin Rozov bought about $1.2 million worth. Jordan Levy picked up $500 worth.
Okay, so buying and selling.
Right. And it's worth remembering, companies like this usually have pretty strict insider trading policies, blackout periods, pre-clearance requirements. So while selling isn't ideal to see, it doesn't automatically mean insiders lack confidence. It could be for personal financial planning or diversification reasons, but the director buying is certainly a positive signal to counterbalance that.
Let's switch gears a bit to the technical side. For a stock going through such a huge change, you'd expect a bumpy ride on the chart.
You would, and you'd be right. Core Scientific has shown extreme volatility. Its 30-day annualized volatility is, get this, 107.4%.
Wow, 107%. That's
intense.
It is. That tells you the price can swing wildly day to day, so definitely not for the faint of heart in the short term. Despite that volatility, the stock has gained about 16.4% over the past 6 months. It's currently around $16.36, up from about $14.05 6 months ago.
With that kind of movement, are there any key price levels investors should keep an eye on? Support, resistance? Yes, definitely. The 6-month high was $16.89, so it's near that peak. The low over that period was way down at $6.20. Key support seems to be identified around the $10.90 level. Key resistance is around $14.70, which it's currently above. And technically, it's trading above all its major moving averages. The 20-day, 50-day, and 200-day are all below the current price. That typically indicates a bullish trend is in place.
Okay, bullish trend, but extreme volatility. Now, let's talk risk. We've touched on some, but what are the primary risks people really need to understand here?
This is absolutely critical. The potential is there, but so are the risks. Let's break them down. First, execution risk. This is huge. They have to deliver that contracted infrastructure to CoreWeave on time and working correctly. Any big delays or problems could really damage revenue and their reputation.
Right, they have to prove they can do it at scale.
Exactly. Second, customer concentration. Right now, so much of their future revenue depends on CoreWeave. If anything happened to that relationship, it would be a massive blow to their business model. Diversification will be key later on. Third, high debt. They're carrying over $1.1 billion in debt. That financial leverage could become a real problem if the market turns down or if interest rates spike. Fourth, capital requirements. Building out all this AI infrastructure costs a lot of money. They might need to raise more capital down the line, potentially through selling more stock, which could dilute existing shareholders. Fifth, AI market volatility. Yes, it's growing fast now, but the AI infrastructure market is still pretty new. Technology can change quickly or demand could shift unexpectedly. And sixth, competition. The big cloud providers, Amazon, Microsoft, Google, and traditional data center companies are all jumping into this space aggressively. Competition is definitely heating up.
Okay, that's a significant list of risks to weigh. Execution, concentration, debt, capital needs, market shifts, and competition.
And you also have sector risks like finding enough power in real estate, plus macroeconomic factors like interest rates, potential regulations, energy costs, and the overall economy.
Got it. So looking ahead, for investors thinking longer term, what are the key catalysts? What should they watch for that could drive the story forward?
Good question. In the near term, say the next 6 months, the big one is the Q2 2025 earnings report, expected around August 6th. Analysts are forecasting a small loss per share, Rannetic and others of 7 cents, reflecting those ongoing transition costs. But the commentary on the CoreWeave build-out will be crucial. Even sooner, we need to see confirmation of delivery for that first 8-megawatt tranche to CoreWeave by the end of June, and then another 40 megawatts by the end of Q2. Hitting those milestones validates their execution.
Okay, so near-term execution proof points. What about further out, say 6 to 18 months?
Over that medium term, we'll be watching for progress on further site development. Critically, hitting that target of delivering the full 250 megawatts to CoreWeave by the end of 2025. And then starting to see signs of customer diversification. Landing contracts beyond CoreWeave would really help de-risk the story. There's also potential for M&A activity in the space. Longer term, of course, the continued expansion of the overall AI market should provide sustained demand, assuming they execute well.
All right, so pulling this all together, if someone is looking at Core Scientific now, considering an investment, what's the final recommendation based on this analysis?
Okay, summing it up, the company gets that moderate 6 out of 10 rating from us. It reflects this really interesting, successful strategic pivot into AI infrastructure. But that's offset by those very real execution risks, the customer concentration and other market challenges we discussed. They've positioned themselves well in a high-growth market, no doubt, but they face big hurdles in actually delivering the capacity they've promised and broadening their customer base. For a long-term investor, we think the optimal entry range is probably between $10.50 and $12.50 per share. Getting in below $10.50, if the opportunity arises, would offer, potentially exceptional risk-adjusted returns. Entering above $12.50 starts to reduce that favorable risk-reward balance. It's really better suited, we think, for long-term investors, people with a 2 to 3 year time frame, who can handle the volatility while this AI transformation story hopefully unfolds successfully.
And given that extreme volatility, 187%, any specific risk management advice for our listeners?
Absolutely crucial with this one. First, position sizing. Given the speculative nature in that volatility, keep it small, maybe 2-3% of your total portfolio. Max, don't bet the farm.
Right.
Second, consider a stop loss. Setting one around $9.50, which is just below that key technical support level near $10.97, could help limit your downside if things go wrong. And on the upside, a take-profit target somewhere between $18 and $20 seems reasonable. That aligns with current analyst targets and would represent a solid gain if the execution pans out. So ultimately, Core Scientific is a compelling turnaround story, yes. It offers exposure to the booming AI infrastructure market. But success really depends on them flawlessly executing those contracts and diversifying their clients over time. It's high risk, high potential reward.
So what really stands out for you after going through all this? As we wrap up, maybe something for you, the listener, to think about. In an era where technology shifts so fast, how do companies like Core Scientific companies that manage to pivot their existing large-scale, maybe even somewhat traditional infrastructure to meet these completely new demands, how do they change how we think about value and growth? Is finding new uses for old, capital-intensive assets the next big wave of value creation? Something to ponder. Thank you for joining us for this look at Core Scientific. We hope you feel much more informed and confident in understanding their complex story and their path forward. Join us next time on Investing Talk Podcast for another in-depth analysis.